Hey everybody, Courtney Smith here with our January 23rd, 2023 edition of Wall Street Winners. Let's get right into it here. So, the market, we're basically where we were at the same time last week, but we had a rally early in the week, we had a dip late in the week, but then a very strong Friday. I think that the bull market's back in place, as I said last week, but I also said we'd have a dip. We've got the dip is over. I'll show you the seasonality in a second to prove my case here. We're still seeing that the purple predictor is a bit weak here, and that's telling me that we're not going to see a super bull market here. It's going to be bullish, but it's going to be sloppy, it's going to be choppy. That's what all of this combines to tell me. Dow, same story here. And you can see that even here, notice that the Dow was much weaker than the S&P. We'll come back to that in a minute. And you can see here the little red line shows that selling pressure ended the week a little bit higher than buying pressure, although we're still kind of neutrally. Notice that the Dow is no longer the leader to the upside. Let's go back to the previous chart. Oops, that's not the previous chart. Look at these highs right here. We're still under the highs that we made in December, okay? Over here, below the highs we made in December. Over here, below the highs we made in December. So this is not a powerful bull market, but I think that the NASDAQ is going to start to be the leader to the upside. Purple predictor, not bearish at all. And I'm going to show you some other things that tell me that we're going to start to see the NASDAQ become the leader here. Wow, 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 wow. We cannot break through my buy signal here for our seasonality indicator. We got back up to it again. We sold off. We were strong on Friday. So it looks like this week we'll probably break through here. Notice how the purple predictor, which is on balance volume, is very strong here. This is a chart of the Russell 2000, which are 2,000 small cap stocks, and they're really starting to outperform. I just told you about the highs in December. Here they are over here. The other three big indices weren't really that close. But look at this. IWM, small cap stocks, very close. Another reason why small cap stocks are outperforming the mega caps are because small cap stocks are mainly domestic. That is to say, their market is in the U.S., whereas the S&P 500, 50% of its earnings come from outside the United States. So the S&P is really a global index, but the IWM is a USA-only index, okay? So this is telling us that the U.S. economy is going to be much stronger than overseas economies. Utilities, who cares? This looks like we're right now going to have a nice squirt to the upside, a little juke here, but then another rally. The first time we really see any significant danger is over here in the middle of February. So we've got several weeks to go of pretty clear sailing from a seasonality perspective. Asset allocation, still boring. Money for this rally is not coming from the bond market, it's coming from cash. People aren't increasing their margin debt. They're not borrowing money to buy stocks. They're taking money from out underneath their pillow and putting it into the stock market. That's where the money's coming from. And look at this. They're buying higher risk stocks. This is showing that the market is looking for higher risk stocks, technology, biotechnology, rather than Utes and consumer staples. That's what this is saying. Now, institutional investors are staying very conservative. So I think this move into riskier stocks is coming from, guess what? Retail investors. I'm going to show you the Bitcoin chart in a minute. It looks a lot like the Riskicator. You'll see what I mean in a second. A long stagnant period followed by a straight line up. So the risk that's coming back in the market is going back into meme stocks, stocks with high short interest, Bitcoin and crypto. In other words, super high risky stocks, super high risky investments of any type. Global shares continue to rock and roll, and yield curves getting worse. And once again, this is becoming a major, major problem. So I need to explain this a little bit to you. This depth and length of the yield curve being negative, and also looking at the 2-year minus 10-year yield curve, is telling me that we're going to see a long and deep recession. Now, the market's talking about recession, but I don't see anything on the front page of the New York Times. I don't see anything on the front page of the Chicago Sun-Times, on the front of the Seattle Post-Intelligencer, or the New Orleans Times-Picayune. I'm not seeing it. So the consciousness that we're going into a recession right now, here in the month of January, will be a resumption of the recession, is not sinking into the general public, politicians, the mainstream media. Wall Street, yes. Wall Street, yes. That's why the market sold off last week. Worries about recession. But at this stage of the business credit cycle, bad news is good news, because the market will say, oh, we've got a recession coming. That means the Fed will stop tightening and will start easing. That's bullish. So remember that. When you see bad news about the economy, that's good news for the stock market, because the stock market is discounting what's going to happen 6 months from now. Now, of course, you're listening to me here on Wall Street Winners because you want to know what the newspaper is going to say 6 months from now, and I'm revealing it to you right now. Bonds, I think, are going to continue to rally, but it's not going to be much of a rally. I'm not playing the bond market right now at all. Bond key factors a bit bullish here, mainly because 10-year treasuries are coming down in Germany. CRB is a bit weak, but gold is very strong. So net, it's saying we're going to have lower interest rates, but no big deal. Not worth really trading in my mind. But it does kick out one of the important things that was supporting the dollar. We're now in a major bear market in the dollar. It's going to take quite a while before we see the bull back. So want to be short the dollar against almost anything. Not everything, but almost everything. But gold is rallying very strongly. Now, one of the interesting things, I was just looking to try to find a nice gold company to buy, and they all have terrible earnings. Most of the top 20 biggest gold companies all have declining earnings, and analysts expect them to decline next year too. Well, I just can't buy a company that's shrinking. I want to buy companies with high earnings momentum. Gold companies don't have that. So I think it's best to be in the metal, not the companies at this point. Gold key indicators remain 2 bullish, 1 neutral. That's a good reading. You don't want to go mortgage your house, get a second mortgage on your house to buy gold. But putting a little bit into gold is probably not a bad idea here. I don't have any position in gold. I've been trying, and I don't have one. Metals, yes. Materials, yes. Mining, yes. Oil, yes. Everything, but I don't have gold shares, or gold for that matter. I'm getting more bullish on crude oil. I've been sort of waffling, as you know, if you're a regular listener. But a couple things are going on here. The world is going into a global recession, and that's going to reduce demand for oil. But what we're seeing is that the supply of oil in ready hands, that is to say inventories ready to be processed, is very low. And so I think a lot of what's happening here is that people are looking for the economy, they're looking beyond, they're looking to Fed easing, and they're saying that's going to perk up the demand for oil. But really what's happening, I think, is there's a reduction in supply. So we're going to monitor this much more closely for you to get the underlying facts. Now, as I mentioned, risky assets are back. So, of course, that means I've been wrong. I thought we were going to break these lows in Bitcoin. Didn't happen. Instead, we exploded to the upside from 17 to 23,000. That's a really good move. We broke above these highs. We barely broke above these highs, but still, you got to give it credit. Purple predictor neutral, but we did this rally on increasing volume, so that says it's a good rally. And so my thesis is the Bitcoin market is now, the crypto market is now looking at Fed easing, and that will spark the frothiness that we saw last year, or really the year before, 2021. So we got to keep an eye on this. All right, freebies. I've just told you about tomorrow's newspapers. Don't you want to get and figure out how to make money from this? Wouldn't that be a good idea? Well, then subscribe. It's easy, it's cheap. Hey everybody, Courtney Smith here, and I just wanted to kind of reveal with you one of my secrets of my success, and that is I use a website called stockbutler.com. And the reason I use it is because it saves me so much incredible time, and it was based on my forms of analysis. The Stock Butler was developed by one of my brilliant students. Of course, all my students are brilliant, you know that. And he designed it around my technique for fundamentally selecting stocks. So all you have to do is you come here, you go to rate, you go to best of the best, that's the name of the technique, and bingo, there's the list. And then, since there's only 4 stocks there, no problem. Go up to rate, go down here to advanced stock list. I usually change this to main E-table, update the list. Anything in green, I'm interested in. Now, I know that these are fundamentally powerful stocks. Now, all I have to do is go find the correct technical entry and exit point. So, Stock Butler saves me a tremendous amount of time, keeps me focused on only the best of the best stocks instead of wasting my time on other garbage. All right, everybody. We'll see you later.